8 signs a rental property will be a financial drain. Investing in a rental property can be a powerful path to building wealth, generating passive income, and securing your financial future. In the realm of real estate, a well-chosen property can yield consistent returns and long-term appreciation, but a poorly selected one can become a relentless financial drain, sapping your resources and derailing your goals. Some investors thrive, picking properties that cash flow effortlessly, while others struggle, tied to money pits that demand endless repairs or fail to attract tenants. Is the rental property you're eyeing a potential gold mine or a looming financial disaster? In this article, we're diving into 8 signs, grounded in real estate research and insights from trusted sources like the National Association of Realtors, NAR, Zillow, and BiggerPockets, that indicate a rental property could drain your finances. These aren't just red flags, they're evidence-based markers of risk, drawn from studies on rental market trends and property investment analysis. By the end, you'll recognize these signs in any property, understand why they matter, and learn actionable steps to avoid costly mistakes or mitigate risks. Stay with us until the end, because the choices you make today can shape your real estate success tomorrow. Let's get started. Sign 1. The property requires frequent or costly repairs. One of the clearest signs a rental property will be a financial drain is if it requires frequent or costly repairs, such as ongoing plumbing issues, roof leaks, or structural damage. Older homes or those in poor condition can devour your budget with unexpected maintenance, reducing profitability. According to a 2024 Home Advisor report, rental property repairs average $3,000 to $7,000 annually, but neglected properties can exceed $15,000, especially for major systems like HVAC or foundations. Imagine 2 investors, Sarah and Ethan, each buying a $200,000 rental. Sarah's property, a well-maintained duplex, needs $2,000 yearly for minor fixes, preserving her $12,000 annual profit. Ethan's fixer-upper demands $10,000 annually for plumbing and electrical repairs, wiping out his $8,000 profit. Sarah's low-maintenance property signals a sound investment, while Ethan's repair-heavy home indicates a financial drain. This aligns with BiggerPockets' 2023 investment guide, which warns that high repair costs can turn a promising rental into a loss. Frequent repairs don't just cut into cash flow, they deter tenants and lower property value. To avoid this, hire a professional inspector before buying to identify issues like outdated wiring or water damage, costing $300 to $500 but saving thousands. Budget 1 to 2% of the property's value annually for maintenance, $2,000 to $4,000 for a $200,000 home. If the property needs major work, negotiate a lower price or walk away. Ask yourself, does this property require frequent or costly repairs, or is it in solid condition? The repair burden is a critical sign of a potential financial drain. Sign 2. The neighborhood has declining property values. If the neighborhood has declining property values, marked by falling home prices, vacant lots, or economic stagnation, it's a strong sign the rental property could be a financial drain. A declining market reduces your property's appreciation potential and resale value, locking you into a losing investment. A 2024 Zillow study found that properties in neighborhoods with 2% plus annual price declines lose 10 to 15% of their value over 5 years, eroding equity and rental appeal. Picture 2 landlords, Emma and Noah, each owning a $250,000 rental. Emma's property is in a growing suburb with 4% annual price growth, increasing her equity by $50,000 in 5 years. Noah's rental, in a declining industrial area, drops 3% yearly, losing $37,500 in value and attracting lower-quality tenants. Emma's appreciating neighborhood signals a strong investment, while Noah's declining market indicates a drain. This echoes NAR's 2023 market analysis, which highlights neighborhood trends as a key predictor of rental success. Declining values don't just hurt equity, they signal weak tenant demand and higher risks. To assess this, check Zillow or Redfin for the area's 5-year price trends, aiming for 2% plus annual growth. Research local economic indicators, like job growth or school quality, using sites like City Data. If values are falling, consider properties in nearby stable markets. Ask yourself, is the neighborhood's property values rising or declining? The market trend is a sign of a financial drain. If you're finding this insightful, comment number 2 below to let me know you're here, and let's keep going. Sign 3. Local rental demand is low or inconsistent. Low or inconsistent local rental demand, evidenced by high vacancy rates, long leasing periods, or seasonal fluctuations, is a critical sign a rental property could drain your finances. Weak demand leads to vacant months, forcing you to cover the mortgage without income. According to a 2024 apartment list report, markets with vacancy rates above 7% result in 20% lower rental returns, as landlords face 1 to 2 months of lost rent annually. Consider two investors, Ava and Liam, with $300,000 rentals. Ava's property, near a university, has a 3% vacancy rate, leasing quickly at $2,000 per month, yielding $22,000 yearly after expenses. Liam's rural rental, with a 10% vacancy rate, sits empty 3 months a year, netting only $15,000. Ava's strong demand signals a profitable investment, while Liam's weak demand indicates a drain. This aligns with Roofstock's 2023 rental guide, which stresses high demand for consistent cash flow. Low rental demand doesn't just cut income, it increases marketing costs and tenant turnover. To evaluate this, check local vacancy rates on Rent Cafe or HUD, targeting areas below 5%. Analyze rental listings on Zillow to confirm properties lease in under 30 days. If demand is weak, explore nearby high-demand markets or properties near job centers. Ask yourself, is local rental demand strong, or low and inconsistent? The rental demand is a sign of a financial drain. Sign 4. Property taxes or HOA fees are unusually high. If property taxes or homeowners association, HOA fees are unusually high, exceeding local averages or eating into your rental income, it's a clear sign the property could be a financial drain. High taxes or fees reduce your profit margin, making it hard to cover costs. A 2023 ATTOM data study found that properties with taxes above 1.5% of value or HOA fees over $500 per month cut net rental returns by 25%, as fixed costs outpace income. Imagine two landlords, Lucas and Mia, with $200,000 rentals generating $1,800 per month. Lucas's property has $3,000 annual taxes, 1.5%, and no HOA, leaving $15,000 profit. Mia's condo has $5,000 taxes, 2.5%, and $400 per month HOA fees, slashing her profit to $8,200. Lucas's reasonable costs signal a viable investment, while Mia's high fees indicate a drain. This echoes Bankrate's 2024 Rental Investment Guide, which warns of tax and HOA impacts on profitability. High taxes or fees don't just shrink profits, they limit flexibility for maintenance or upgrades. To check this, review the property's tax bill via the county assessor's website, aiming for 1 to 1.5% of value annually. Confirm HOA fees in the listing or with the association, targeting under $300 per month. If costs are high, negotiate the purchase price or seek properties with lower taxes. Ask yourself, are property taxes or HOA fees reasonable or unusually high? The fixed costs are a sign of a financial drain. If this resonates with you, comment number 4 below to stay engaged, and let's move forward. Sign 5. The cost of utilities is significantly above average. When the cost of utilities, such as water, electricity, or gas, is significantly above average due to property size, age, or inefficiencies, it's a sign the rental property could be a financial drain. High utility costs reduce your profit if you cover them or deter tenants if they pay, lowering demand. A 2024 Energy Star report estimates that inefficient rentals cost $500 to $1,000 more annually in utilities than efficient ones, cutting landlord margins or tenant appeal. Picture two rental owners, Chloe and Owen, with $250,000 properties. Chloe's modern apartment, with efficient HVAC, incurs $1,200 per year in utilities, covered by tenants who appreciate low bills. Owen's old Victorian home costs $2,500 per year due to poor insulation, prompting tenant complaints and vacancies. Chloe's low utilities signal a strong investment, while Owen's high costs indicate a drain. This aligns with the U.S. Department of Energy's 2023 rental analysis, which links utility costs to tenant retention. High utilities don't just raise expenses, they signal inefficiencies that hurt long-term value. To assess this, request utility bills from the seller for the past 12 months, comparing to local averages on utility score. Budget $100 to $200 per month for landlord-covered utilities. If costs are high, factor in upgrades like insulation, $2,000, to offset expenses. Ask yourself, are utility costs average or significantly above norm? The utility burden is a sign of a financial drain. Sign 6. The property lacks energy-efficient features. If the property lacks energy-efficient features, like modern insulation, double-pane windows, or Energy Star appliances, it's a warning sign it could be a financial drain. Inefficient homes drive up utility costs and require costly upgrades, reducing profitability. A 2023 NAR study found that energy-efficient rentals command 5 to 10% higher rents and have 15% lower vacancy rates, as tenants prioritize low bills and comfort. Consider two investors, Harper and Jacob, with $220,000 rentals. Harper's property has LED lighting and a new HVAC, attracting eco-conscious tenants at $1,900 per month with $1,000 annual utilities. Jacob's outdated home lacks efficiency, leasing for $1,700 with $2,200 utilities, netting $3,000 less yearly. Harper's efficient features signal a profitable investment, while Jacob's inefficiencies indicate a drain. This echoes Energy Star's 2024 Landlord Guide, which highlights efficiency as a competitive edge. Inefficient properties don't just cost more, they lose appeal in a market favoring sustainability. To evaluate, check for efficiency features during a walkthrough, like window ratings or appliance labels. Estimate upgrade costs, e.g., $5,000 for windows, against rent increases using Energy Star Savings Calculator. If the property lacks features, negotiate a lower price to fund upgrades. Ask yourself, does the property have energy-efficient features, or is it outdated? The efficiency level is a sign of a financial drain. If you're finding this valuable, comment number 6 below to let me know you're here, and let's move forward. Sign 7. Insurance costs are high due to location risks. High insurance costs due to location risks, such as flood zones, wildfire-prone areas, or high-crime neighborhoods, are a strong sign a rental property could be a financial drain. Elevated premiums cut into profits and signal potential property damage, increasing expenses. A 2024 CoreLogic report estimates that rentals in high-risk areas face insurance costs 20 to 50% above average, with flood zone premiums averaging $1,500 to $3,000 annually versus $600 for low-risk areas. Imagine two landlords, Olivia and Mason, with $280,000 rentals. Olivia's property, in a low-risk suburb, has $700 per year insurance, preserving her $14,000 profit. Mason's coastal rental in a flood zone costs $2,500 per year to insure, reducing his profit to $11,200. Olivia's low insurance signals a sound investment, while Mason's high costs indicate a drain. This aligns with the Insurance Information Institute's 2023 guide, which warns of location-based risks for rental profitability. High insurance doesn't just raise costs, it flags future liabilities, like storm repairs. To check this, request an insurance quote from providers like State Farm, factoring in flood or wildfire risks via FEMA's flood maps or CoreLogic's risk reports. Budget 0.3 to 0.5% of the property's value for annual premiums, $600 to $1,000 for a $200,000 home. If costs are high, consider properties in lower-risk areas. Ask yourself, are insurance costs reasonable or high due to location risks? The insurance expense is a sign of a financial drain. Sign 8. The rental income barely covers the mortgage. If the rental income barely covers the mortgage, leaving little for taxes, insurance, maintenance, or profit, it's a glaring sign the property will be a financial drain. A healthy rental should yield a net positive cash flow after all expenses, ideally 8 to 12% of the purchase price annually. According to a 2024 Roofstock analysis, properties with rental income below 1% of the purchase price monthly, e.g., $2,000 for a $200,000 home, often result in negative cash flow, especially with rising costs. Picture two investors, Sophia and Liam, with $300,000 rentals. Sophia's property rents for $2,800 per month, covering a $1,500 mortgage, $500 taxes/insurance, and $300 maintenance, netting $500 profit. Liam's rents for $1,800, barely covering his $1,500 mortgage, leaving nothing for other costs and requiring him to subsidize $400 per month. Sophia's strong cash flow signals a viable investment, while Liam's tight income indicates a drain. This echoes BiggerPockets' 2024 cash flow guide, which stresses the 1% rule for rental viability. Low rental income doesn't just eliminate profits, it risks forcing you to dip into personal funds. To assess this, calculate the rent-to-price ratio. Divide monthly rent by purchase price, e.g., $2,000 divided by $200,000 equals 1%. Aim for 1% plus and positive cash flow after expenses, mortgage, taxes, insurance, 10% vacancy, 10% maintenance. Use Roofstock's calculator to test scenarios. If income is tight, negotiate a lower purchase price or seek higher rent properties. Ask yourself, does the rental income comfortably cover the mortgage and expenses, or barely break even? The cash flow is a sign of a financial drain. Final thoughts. A rental property can be a cornerstone of wealth building, delivering income and appreciation when chosen wisely. Reflect on these 8 signs. Does the property need costly repairs, or sit in a declining neighborhood? Is rental demand weak, taxes high, utilities excessive, or efficiency lacking? Are insurance costs elevated, or does the rent barely cover the mortgage? If these resonate, the property risks being a financial drain, but you can avoid pitfalls with diligence and strategy. Take action today. Schedule an inspection to uncover repair needs, or research a neighborhood's 5-year price trends on Zillow. Check local vacancy rates, compare taxes to county averages, or request utility bills. Get an insurance quote, assess efficiency upgrades, or calculate cash flow with a 1% rule. Your rental investment is a commitment to your financial future, so approach it with clarity and caution. Listen to the property's signals and market data, because the choices you make today will shape the wealth you build tomorrow.